Today, we're going to slow down, zoom in, and truly understand what this chart is trying to tell us. Candlestick charts can look confusing, but once you learn how to read them, they become the clearest window into market psychology. And the chart you're looking at right now is a perfect example of how the market speaks through candles. We're going to break down the last few hours of movement and explain exactly why the price first pushed upward and then reversed downward. By the end of this video, you'll understand the story every candle is telling. Every candlestick is a message, tells you where price opened, where it closed, how high it went, and how low it dropped during that time period. If the candle is green, it means buyers won. If it's red, sellers controlled that time frame. The wicks show the fight, the attempts by buyers or sellers that got rejected. And learning to read these small clues can completely change how you understand charts. Let's begin with the earlier movement you see on the chart. When you look closely, the market started with a nice series of green candles. These weren't weak or uncertain candles. They were solid, steady, controlled moves upward. Whenever a chart shows multiple green candles back to back, it's a sign that buyers are stepping in confidently. In simple words, the market sentiment was positive. Buyers were ready to push higher. Sellers weren't strong enough at that point to interrupt the upward move. But there's more to notice. On these green candles, the bottom wicks are small. That's a big signal. It means sellers did try to push the price down, but buyers immediately rejected that attempt. And when you see candles that have small lower wicks and strong bodies, it means buyers are defending the price. They're not letting it fall. This kind of price action usually appears when traders expect a breakout or when the market is reacting to some positive sentiment. As the price climbed, more buyers entered because upward movement attracts attention. Traders think the market is going up. Let me get in before I miss the move. This psychological reaction creates more buying pressure, which pushes the candles even higher. That explains why the chart earlier shows such clean upward flow. Buyers were united, confident, and in control. But markets don't move in one direction forever. Something always signals a change. Now look carefully at the candle that appears next. The one with the long upper wick. This candle is extremely important, and it's one of the most powerful signals beginners often ignore. This candle tells us that buyers tried to push the price much higher, but sellers came in aggressively from the top and pushed the candle back down. Even though the candle might still be green or neutral, the long upper wick is the key. It shows rejection at higher prices. It shows hesitation, shows that buyers are starting to lose strength. This is usually the candle where the market begins to shift. Picture it like a tug-of-war. Buyers had been pulling the rope upward for a while, but suddenly sellers pulled hard in the opposite direction. That wick is the sellers pulling. Right after that rejection candle, pay attention to what happens next. You start seeing red candles forming. And these are not small, confused red candles. These are candles with clear downward movement. Their bodies are strong, and their upper wicks are longer, meaning buyers attempted to push back, but sellers rejected every attempt. This is the moment the market tells you the move upward is over. Sellers have entered. The shift from green strength to red pressure is one of the most reliable signals in chart reading. The market always shows these hints before it fully reverses. First, you get strong upward candles, then you get a candle with a long upper wick, the warning sign. Then you get red candles confirming sellers have taken control. The important thing to understand here is that price action is never random. Something in the market environment triggered this shift. Could be news, a resistance zone, a psychological price level, or simply profit-taking by traders. But the candles show it before anything else. The rejection wick told you sellers were interested. The red candles confirmed they took control. Now let's look deeper. Notice how the later red candles have long upper wicks. This means buyers tried to lift the price back up, but sellers refused to let it happen. This is what we call consistent rejection. Every time buyers attempted to push upward, sellers pushed back harder. And when this pattern repeats, it means the market sentiment has clearly changed. Sellers are now dominating. Another important thing you'll notice is that the market isn't falling in a straight line. It's making small attempts upward and then rejecting again. This is exactly how real markets behave. They don't just crash or pump immediately. They fight, they test, they push and pull. These mini attempts upward are what we call retests, and each retest creates another wick. The more wicks you see on top of red candles, the stronger the seller pressure is. This chart perfectly illustrates that moment when the market transitions from confidence to doubt, then from doubt to a full reversal. First, buyers were excited, and the market hit a zone where sellers were waiting. Then sellers gained strength. And finally, the downward momentum continued because buyers stopped defending the price. When reading a chart like this, always pay attention to momentum. Early on, the green candles were strong and smooth. Later, the red candles became more powerful and consistent. This shows how momentum shifts from one side to the other. Once you start seeing repeated rejection wicks on top of red candles, it tells you the sellers are winning the battle. Let's talk a bit about psychology, because candles always reflect human behavior. When the price was going up, buyers felt confident. Traders entered the market thinking the upward move would continue. But once the rejection wick appeared, uncertainty started creeping in. Some buyers closed their positions to lock profits. Some sellers entered thinking the market was too high, and the combined effect created downward pressure. Then, as red candles continued forming, confidence shifted again, this time in favor of sellers. People who were holding long positions started closing them. Some traders opened short positions. Buyers who tried to push upward were rejected repeatedly. This psychological shift is exactly what creates reversal patterns in charts. When you look at the chart again with this understanding, the entire story becomes clear. You can literally read what traders were thinking. The candles show confidence, hesitation, rejection, and reversal, step by step. And this is the power of learning price action. You don't need complicated indicators. You don't need hundreds of tools. The chart itself tells you everything if you know how to read it. Before we wrap up, remember one thing. No chart moves in isolation. What you see on the screen is the result of millions of decisions made by traders all around the world. And candles are simply the visual representation of those decisions. Once you learn how to read them, you gain an advantage that many traders never develop. And before we finish, here's an important reminder. This video is for educational purposes only. I am not a financial advisor, and I am not responsible for any profit or loss. My goal is simply to teach you how to understand charts better so you can make more informed decisions on your own.